Pig butchering. The name is a translation of a Chinese phrase, 杀猪盘, fattening the pig before the slaughter, and it describes the operation exactly. A stranger messages you by accident. Wrong number, wrong name, apologies all round. The conversation continues anyway. Over the following weeks, they're warm, consistent, completely uninterested in money, and they never once ask you for anything. That's the fattening. Somewhere around week 6, they mention an investment platform they use. You look, it's polished. An app, a dashboard, live prices, customer support. You put in a small amount. It grows. You withdraw a little, successfully. And that withdrawal is the single most important step in the entire operation because it converts suspicion into trust. Then you put in everything. The platform is fake. Every number on that dashboard was typed by a person. The tell isn't the platform, which is usually flawless. It's the accidental first message.
Nobody finds their financial advisor through a wrong number. Ponzi schemes. In 1920, a Boston man named Charles Ponzi promised investors 50% returns in 90 days by exploiting price differences in international postal coupons. The arbitrage was real. It was also impossible to run at scale, so he stopped trying and simply paid earlier investors with money from later ones. The scheme lasted about a year and cost investors roughly $20 million, around $300 million in today's money. Every Ponzi since has worked identically. There is no underlying business. There are only two flows of money, in and back out to whoever complained loudest. That structure carries one unavoidable mathematical property. It requires continuous new deposits forever, and there is no forever. The tell isn't the size of the return, it's the smoothness of it. Real markets are jagged. Real investments have bad quarters.
A fund that returns exactly 1% every month for 6 years isn't skilled. It's fabricated. Affinity fraud. This isn't really a separate scam so much as the delivery system for all the others, and it's the reason intelligent people fall for obvious things. The fraudster doesn't approach strangers. He joins a group, a congregation, an expat community, a professional association, a veterans network, and spends months contributing nothing but goodwill. Then he invests one respected member first and pays them handsomely. That member does the rest of the selling for free and does it far better than he ever could because they genuinely believe it. Due diligence collapses inside trusted groups. Nobody audits a friend. Nobody asks a community elder for a prospectus. Regulators consistently rank affinity fraud among the most damaging categories precisely because victims won't report it. The tell isn't the pitch.
It's who handed it to you and how little you checked because of who they were. Advance fee fraud. You've won, you've inherited, you've been selected, you're owed. And to release it, there's just one small payment first. A processing fee, a tax clearance, a courier charge. The amount is always tiny relative to the prize, which is the entire mechanism. And here's the part almost everyone gets wrong. The famously terrible spelling and absurd storylines aren't incompetence. Researchers studying these operations concluded the errors are largely deliberate. A believable, well-written message attracts thousands of replies, mostly from people who'll ask questions and drop out. And every one of those conversations costs the scammer hours. An obviously ridiculous message filters the pool down to the most credulous before a single minute is spent. The bad grammar isn't a mistake they're making, it's a screening tool they're using. Drop the strangest one you've ever received in the comments. The tell has never changed. Money that already belongs to you never requires you to send money first. Pump and dump. Somebody buys a large position in something almost nobody trades, a microcap stock, a new token, where the float is small enough that their own buying moves the price. Then the promotion starts. Coordinated posts, paid influencers, a story about a partnership or an imminent announcement. The chart begins climbing, and the climb is the advertisement. New buyers arrive because the price is rising, and the price rises because new buyers are arriving. And for a few days, the thing genuinely works. Then the original holder sells into that demand, all of it, and the price collapses within minutes to below where it started. Modern versions run inside private groups, where members pay for the signal, unaware the people running the group entered hours earlier. The tell is the urgency. Real opportunities don't expire in 4 hours.
Anything requiring you to act before you can think was engineered that way deliberately. Multi-level marketing. This is the one that's legal, and that legality does an enormous amount of work. An MLM sells real products through independent distributors who also recruit other distributors and earn from their sales. Structurally, that's a pyramid with merchandise attached, which is precisely what keeps it lawful. The numbers, though, come from the company's own published income disclosures. Across the industry, somewhere between 70 and 99% of participants lose money once inventory, training, events, and fees are counted. Median annual earnings in many disclosures sit in the low hundreds of dollars, before costs. That isn't a scandal being concealed. It's printed publicly in documents nobody opens. MLM isn't a business opportunity that sometimes fails. It's a customer acquisition model where the sales force are the customers. The tell is where the money comes from.
If recruiting pays better than selling, the product isn't the product. You are.
Task scams. The message offers remote work, reviewing hotels, rating videos, completing simple app tasks. The first day is real. You do 20 tasks, you're paid $9, and it lands in your account. That payment is the entire investment the scammer makes in you. Then the structure changes. To unlock higher-paying tasks, you must fund your own account first. Deposit 40, complete the set, earn 60. That works too. So you deposit 400. And somewhere in that set, a task fails, or a rule was breached, or a combination task appeared. And to release your balance, you must deposit again. Every deposit generates a fresh reason to deposit. This category has grown faster than almost any other in recent years because it targets people who need income immediately, which is the state in which everyone's judgment is worst. The tell is permanent. No legitimate job has ever required the employee to pay the employer. Business email compromise.
There's no malware here, no hacking, no technical intrusion of any kind. Someone watches a company's email long enough to learn its rhythms, who authorizes payments, how invoices are worded, when the finance director travels. Then on a Friday afternoon, the accounts team receives a message from a known supplier saying their banking details have changed. Please update for this month's invoice. The wording is right, the invoice number is right, the amount matches what was genuinely owed. It gets paid. This single technique costs organizations more each year than ransomware does, and it's committed entirely in plain text. Individuals meet the property version, where a buyer receives new wiring instructions days before completion and sends their whole deposit to a stranger. The tell is the change itself. Bank details don't change mid-relationship, and any message saying they have is answered with a phone call to a number you already had, never the number in the email. Recovery scams.
This is the second scam, and it targets exclusively the people who fell for the first one. Victim lists are sold between fraud operations, bought, traded, priced according to how much each person lost. So months after your money disappears, you're contacted by a recovery agency, a blockchain forensics firm, or someone claiming to work for a regulator. They know the exact amount you lost. They know the platform's name. That knowledge feels like proof, and it's simply the receipt from the first crime. They'll recover the funds for an upfront fee, or a release tax, or a bond. There is no recovery. There's a person holding your file, working from the fact that someone who has already lost money is statistically the easiest person alive to sell hope to. The tell is being contacted at all. No genuine agency finds you first. Recovery scams don't target the gullible. They target the desperate, which is a different thing.
Clone firms. A fraudster copies a real, regulated, licensed company. The name, the branding, the registration number, sometimes the entire website, and changes only the contact details and the bank account. You check the regulator's public register. The firm is listed because the firm genuinely exists. What you're speaking to doesn't. Deposits land in a fake dashboard where your balance climbs steadily. Withdrawals are where the second stage starts. A withholding tax, a compliance fee, an anti-money laundering deposit, a percentage required before the transfer clears. Every fee is smaller than the balance you're trying to release, which is exactly the calculation being exploited. Victims routinely send more chasing a withdrawal than they ever invested. The tell is any charge to release your own money. Real institutions deduct fees from your balance. They never ask you to fund the release of it from outside. Deepfake endorsements. A video appears of a national news anchor, or a famous investor, or the richest person alive, announcing a government-backed platform with guaranteed returns. The face moves correctly, the voice is right. A real broadcaster's logo sits in the corner. All of it was generated, and the cost of generating it has collapsed to almost nothing. These run overwhelmingly as paid social advertising, which means a platform was paid to deliver it to you specifically, targeted by your age, income bracket, and interests. Regulator warnings usually arrive weeks after the campaign has ended and move to a new company name. The tell is the endorsement structure itself. Genuinely wealthy people don't need your deposit, and no financial product on earth launches by having a celebrity promise guaranteed returns in a 30-second advert. If it were real, they wouldn't be advertising it. They'd be keeping it. The safe account call. This one is last because it has already reached you.
The phone rings and the number displayed belongs to your bank. Actually displays it, because caller ID can be spoofed trivially and for free. The person knows your name, your branch, sometimes your last transaction. They're calling about fraud on your account. They're calm, helpful, and slightly urgent. Someone is attempting transfers right now, and to protect the balance, they'll help you move it to a secure account held in your own name. You make that transfer yourself. You authorize it. You type the amount. And that is the entire point of the design, because in most banking systems, a payment you authorized is treated very differently from a payment stolen from you. The tell is the destination. Banks do not have safe accounts. There has never been such a thing, and the moment anyone says those two words, the call is the fraud.